following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Tom Schneider, CMT with NinjaTrader, and this is the Traders Workshop segment where we like to feature our NinjaTrader ecosystem partners. And we have one of our original guests back on, as it is options expiration week. We're so thankful to have back on Brent Kochuba, co-founder of SpotGamma. How you doing, Brent?
I'm doing really well. A lot of exciting stuff happening this week, so plenty of stuff to talk about as usual.
Yeah, that's great. I think last time we spoke with you, you were on the West Coast. You're back on the East Coast. Yeah, but we were just reminiscing about 3 years ago because meme stocks are back in the news this week.
Yeah, I busted out my Meme Mania t-shirt. It's been in my closet for nearly 3 years now. And we have GameStop going crazy, AMC going crazy, a couple of new names. Reddit is a public stock, so it's obviously feeling some of the flow there. And I think that's just a general sign of, risk appetite in this market. There's very little macro concern, despite hand-wringing around CPIs and PPIs and things like that. People are out there looking for ways to make a lot of money, and I think that speaks to a pretty bullish environment for stocks.
Yeah, well, a couple thoughts there. Reddit, you mentioned. I think Reddit was kind of the platform where a lot of the, we would call them retail traders, but the ones that kind of drove that, GameStop, AMC, Rise,
right.
They were doing that on Reddit, right? One of the platforms.
Wall Street Bets is a Reddit forum, yeah.
Right, and now they're a publicly traded company. I don't think they were back then, were they?
Yeah, that stock just IPO'd a couple months ago now, and it's up. I haven't checked recently, but it's up fairly substantially over the last couple of days. 10, 20, 30%, something like that. Last I checked, so it's definitely being invigorated by this GameStop craze.
Yeah, and what's interesting is kind of the situation is different in terms of the participants' situation. So 3 years ago, we were in part of the country was still in COVID lockdowns, and you had people out of work and working less. So there was this money being floated to everybody through the government with some loans and some handouts, if you will, that maybe funded some of this craze last time. Now, I mean, that COVID money is dried up, I would say. So, it's just interesting that it's coming back. Maybe it's not so much about the source of money, but it's about how people feel about, like you said, a risk-on environment. What is making these people do these kind of, I would say, risky investments?
Yeah. And I mean, to your point, back then the argument was, well, everyone was locked in their house and they were given, stimulus checks. And I think there's a lot of people who would make the case that it was those stimulus checks that set the stage for inflation, today, which is kind of interesting to think about. But yeah, to your earlier point, I mean, there's people that are chasing a lot of these fast money in moves, right? Crypto, GameStop, things like that, zero DT options. A lot of that is, retail has is a big participant in that. I don't think they're the only participant in that, but it is a sign of behavior, right? When markets were very weak into April, it was all about macro, right? Geopolitical issues, inflation possibly going higher, different things like that, and all stocks were really getting beat up, and the focus was then, and was that. And so now you have the situation where people have very muted concerns about markets going forward. They're simply looking to make the fastest buck they can. And if you're concerned that, the Middle East situation is going to spark off again, or rates are about to go meaningfully higher, you're not going to be, betting on a meme squeezing GameStop, right? Your focus is going to be somewhere else. And so, as I said before, I think it's this is a feature of the current environment we're in, where people just they don't care anymore. Yeah, rates are going higher, but I think they feel like easing is coming, or there's a Fed put in place, or whatever it is. They feel like they're supported in chasing, fast money chasing high risk investments.
Okay, that's I hadn't thought about that. That's really interesting. Um, let's talk about this week, because we're fortunate to have you on options expiration week, and it seems like every time you're on, there's a different story, slightly different story, depending on where we are in the year, really, in the 3 month cycle, if you will.
Yeah.
What's kind of the big thing this week with options expiration?
I think the interesting moment we're at is the market here is 5265 in the S&P 500 is the all-time high. We're just a shade under that, 50 basis points roughly below that all-time high. And that was the level that we were at the start of April. And volatility, if you just use VIX as the measure for volatility, VIX was 13ish right now. That's right around where it was at the start of April. So April was this very big decline. We lost 5% in the S&P 500. At April, OPEX was the low. Powell came out in FOMC right after that. Calmed everyone down, and the market simply ripped back up to that all-time high level, just below that all-time high level, and vols collapsed back down to those lows that we saw at the start of April. So we did this big round robin, and I think where we are right now is we're in this neutral zone, I call it, where people are a little concerned about PPI this morning, which seemed like it was kind of a non-event. Powell speaks today. You got CPI tomorrow, which a lot of people are watching for. Powell speaks again early next week, and then we have FOMC minutes next week, VIX expiration next week, and the other big one that I think deserves attention is NVIDIA earnings, which are coming up on Wednesday as well. So we're at this neutral zone, and I think if there's a signal that rates are indeed set to at least stop going up or coming down, obviously, then that's going to be a good trigger for equities to go higher. And I think if NVIDIA earnings are very strong, then it's really going to boost the narrative that was such a driver of the first quarter of 2024, that, hey, chip stocks are still have larger increasing profits ahead, and that could really re-engage the bull market and set new all-time highs. And so I think we're in this neutral zone. If again PPI is calm, if CPI is also kind of flattish, or there's just nothing for people to get concerned about, then markets are going to, or equities are going to default go higher off of that. And if NVIDIA is good or positive, then that I think is just going to trigger things to move even higher. So I actually am leaning towards all-time highs, setting up into the end of May, because we're just at this neutral zone. And the other thing I'll just add to that quickly is that even though the market was weak into April, vol did move high, but there was never this long-term fear or anxiety that really grabbed over the market. Yes, we had a relative peak in volatility, but there really wasn't, huge put demand, right? It wasn't this real risk off scenario. It was more of what read like a consolidation. And obviously markets going higher allows to sort of Monday morning quarterback a little bit more. But this has just been a market where, I think it by default really wants to go higher. And so there's a little bit of hand wringing around these next few data points. But if those data points get cleared out, then I think equities just continue their path up is basically how I'm seeing it.
Yeah, and that's a great way you described it. It reminds me of a complacent market. Complacent to what the Fed is saying. I worry, and you mentioned NVIDIA Wednesday. That's Wednesday next week. That
22nd,
NVIDIA earnings are coming, and what I kind of think is, looking a little bit past there. If earnings are good, if projections are good, then you've got this demand for products, commodities, to build those chips, to build the data centers, to build the we'll need copper wire for the electricity to fund all these things. That's inflationary. So while the market will rise, there's inflationary pressures that come along with that, kind of looking ahead. And then what does the Fed do, right? Are we backing off on cuts, or are we actually going to raise? And again, this is a very small part of the conversation, but these things do lead, kind of are connected, even though we don't necessarily think of them as connected right away.
Mm-hmm. Yeah, I think too, the other thing that I mean, the macro picture is confusing, and I don't try to really wade through that. I just look at the price action, and the base effect is like, look, we were pricing in 4 or 5 cuts at the start of the year, I think it was. Market's now pricing maybe one later this year. I don't really know. But rates are still, 5+%, right? The risk-free rate, and equities are at all-time highs. And so the idea that higher rates are going to push equities lower doesn't seem to be playing out. And people's fears about inflation. I think people just want to know that inflation isn't set to massively increase. And right now we're just going to keep, cruising, and we're shrugging off risks left and right. And in that environment, imagine if there is a signal that indeed inflation is now coming down and they may cut rates. I mean, I think then you get a knee-jerk reaction much higher in equities, right? It's like you can't fight the price action. It's just going up no matter what you throw at it. And right. So, I think you have to really just take that into account. You could say whatever you want about the risks that are coming up and the fears coming up, but the put buyers aren't out there. There's meme manias going off. We're at all-time highs. You need something to really generate a big unwind of all these flows and positions. And, there's just nothing out there that jumps out at you right now to lead to that big reversal.
Yeah, no, that's interesting. And we've had guests on here that say, higher interest rates, higher stock market, right? More money floating around to push that market up. So I agree, inflationary pressures, maybe not great for the economy, but definitely not necessarily a hindrance to the stock market. I agree. The thing is that I would ask, from just, as a market participant, what would knock this market down, right? You're mentioning all the things that isn't stopping this market, which you might think it would be, but a lot of positive coming too. What would, maybe it's geopolitical, but things seem to be calming down as well in overall.
Yeah, I think it was the pace of, it was a rate of change of interest rates. I think that was so hard for the market to digest. And so I do think if we end up in a situation where we maybe have to talk about hiking again, then that would be a problem. I have no idea if that's even a viable scenario at this moment. I don't think it is. And ultimately, I think the thing that would really bring a risk off, major risk off move would be obviously the geopolitical situation. If there's a whole bunch of ways that could go bad, but the other one is credit markets. And I think when you see credit issues, like commercial real estate or something, that's where you can start to see major sort of forced put buying in the equity space. Because if you own a bunch of bonds on some given company and you think that those are going to be worth zero, the first thing you're going to do is run out and buy equity puts, right, to protect yourself in that scenario. And that's where you see, the most violent moves in my view, in the equity space. And so I don't think we're close to that. If you think back to March of 2023, we got some shades of that, right, where the VIX really started to move and markets very quickly got weaker. Fed came out and supported everything. So, that's the type of scenario where you go, okay, this is going to be a real deal sell-off, right, where vol could really go crazy and we could have a real sharp, nasty decline. And at the moment, if you look at actually implied volatility in the bond ETFs like LQD or HYG, or even TLT, which is a long-term bond government bond ETF, those implied vols are at actual major lows right now. So you have a very complacent equity implied vol market, which suggests people aren't really concerned. And then you see across assets globally, I think there's a few individual commodities like gold or copper where vols are raising, but oil vols very low, FX vols very low, and then obviously these bond credit ETF vols are very low as well. So there's just, people are not worried about anything right now. And that can change fairly quickly. It's just the fact of the matter is, to provoke long-term concerns, you really need to start to have some unknowns. And that's, credit market issues really is the flag that I guess I would throw to cause that change.
Yeah, I've started to see the stories come about, and they're not frequent. They're not something that's going to be the straw right now that breaks the camel's back. But you're starting to see commercial real estate where you hear this building in St. Louis or this building in Dallas sold for 90%, a discount, right, to what was paid 2 years ago. And if those start to pile up, people not going back into the cities to fill the office space, those buildings become very devalued very quickly, and it just becomes a matter of time in my mind. When were those real estate deals funded, and when did those low interest bonds that funded that deal expire and have to be rolled into higher rate bonds, right? And if the company can't absorb that difference, then they start selling at a discount. And we've already started seeing that. So it's really, when does that wave build, right?
Yeah, and we just did a charity lecture series, I guess, or a series of interviews last week. So it's called Charity Day. If you go to the Excess Return podcast, you can check that out and actually donate. It's for a breast cancer charity. But the reason I bring that up is because we had 20 different speakers and a lot of the top macro people that you see on Twitter and the like, and they were all saying, look, 2025 is this time period where things could get really sort of shaky. I think in relation to, credit markets and rates and sort of having to pay the piper and a lot of different things, right? Because at some point, we enter a recession or the Fed starts monetizing position, whatever it is, it's like all these things are lining up more for next year as an issue. And the reason that relates to what you said is because I remember in 2006 when we thought there was all these housing market concerns, or even 2007, Bear Stearns went down, I think, and the market continued to go up. And I'm not here trying to say that the credit market is, anywhere near those previous situations. It's just, I think a lot of these things that we can identify take longer to materialize and actually then drive, equity markets lower. You can identify these problems, but until someone doesn't pay up, or the Fed doesn't bail them out, it's a non-event. And right now you have the election coming up in a couple of months, and I think that most people listening to this conversation right now would probably agree that they're going to do everything they can to paper over any issue before that comes up, right? I mean, that's I think people want to say it's apolitical, but I do think that policies are going to be supportive of equity markets until the election. And then with the election, whoever wins, shifts in policies come around, and who knows what happens after that. But I do think we just had this summer where, yes, commercial real estate is a problem, but it's not tomorrow's problem. So let's buy stocks, right? Because, the other side of the coin is most flows now are in today and out, tomorrow or something, right? They're not worried about what's happening in a few weeks. And so, right. Or even a few months or so, party on, right? While the music's playing.
Right. And you mentioned, the great financial crisis. Yeah, it was like early 2007, we started to see some strains, and really it didn't play out till 18 months later. So, again, you're right. It's looking ahead, not really the focus. And I would say even more so now, one, because there is so much more intraday flow than there was back then, and two, it's a different sector of the market, right? So a lot of times people look for the same kind of signals or same kind of evidence. Oh, what happened in 2007? If they don't see it, well, maybe they're looking in the wrong spot, and that's fine. But there, could be that they're just not concerned with commercial real estate, right?
Yeah, and I would, so you always have to watch the credit market, and I think for signs of stress, right? Because that's generally going to be a signal that equities have higher risk, obviously.
Right.
And then, I think, okay, there's no risk. And if you look at all the data and information and studies on, passive flows, money coming to 401ks and money coming globally in the United States, because it's still the best market there is, and all these different things, like you still have this just natural tailwind, I think, for U.S. equities. And I go back to earnings again with NVIDIA next week. And if they blow it out and they say, look, like everybody's trying to invest in AI and we just can't make enough chips, and people can latch on to this thematic story again of, AI and semis and all this, then what's to stop the market going higher off the back of that narrative? I mean, that was such a powerful driver earlier this year. So, right now we don't have that narrative. There's not that risk off narrative, but, people are looking for that story to grab onto. And if that story grabs on, then I do think it's just going to be a material driver for equities here. There'll be again, a narrative that you can tell yourself is why you need to keep buying stocks.
Yeah, totally agree. we just, when this market rallied off the recent dip, it's just, this market seems to grab on any news event that gives it
Yeah.
some slight positivity to go up.
Yeah, and we had talked in previous OpEx about these measurements of correlation and also dispersion, and there, so if you think about correlation, it what it does is it measures, and you look at, there's a SIBO metric for this COR1M, and correlation has been going down. So what does that mean? That means that people are basically betting that the S&P is not going to do a whole lot, move a whole lot, but individual stocks, specifically the top 50 stocks in the S&P, those implied vols are increasing. So essentially what that means is people are starting to bet again that single stocks are really going to start to outperform. And if you think about how poor market breadth was, and people were throwing all those types of flags in the start of this year, we're starting to see that percolate a little bit again. And what's so fascinating about this is that, if you think about probably the most, one of the biggest individual stock sector bubbles of all time was the 2000s internet bubble, right? And you started to see the same thing where correlation would get lower, dispersion would increase, so individual stocks, just going crazy, right? Kind of like meme mania. And you're starting to see that form a little bit. And what's interesting to me about that is that those kind of surges in dispersion, or these metrics that start to say, hey, some bubbles are forming, those bubbles can last for a while. The internet bubble lasted for, months and months and months before it finally popped in kind of late 2000. So, there's still this form where, hey, credit markets are, commercial real estate's a problem, and there's all these problems that seem like 2025 issues. And if we have a reason to start buying, semi stocks again and chip stocks again and meme stocks again, that condition can last for a while because there's nothing to break that cycle. There's nothing to break that condition down or that narrative down until maybe the election, right? So I just think there's this window where, it's literally like musical chairs, like the music, there's not really a good reason for the music to stop for the next couple of months, right? And you may disagree with that fundamentally, but, price doesn't always match fundamentals.
Right. No, I get that. And, good to know about NVIDIA next week on Wednesday. That usually happens right after the market. So interestingly, in the futures market, we can still participate. I know you can participate, I think 15 minutes after the regular trading hours in stock market, but also we've got up till 5 o'clock. So that I don't know if they report at 4 or 4:05, 4:10, but
yeah, somewhere in that neighborhood.
You'll see some volume there, certainly in NASDAQ.
Right.
At those earnings reports. So good to know when that's happening.
Yeah, and I would just say, that there was a lot of volatility metrics into April that started to look like 2017 in terms of, we hadn't seen such complacency until 2017. And 2017 had the least volatility, I believe, of any year on record. And we have this measure called 1 month realized volatility that we look at. 1 month realized volatility tells you how much the market S&P 500 has moved over the last month. That hit a record low in October of 2017 of 3.5%, which equates to something like 25 basis point moves in the S&P 500. Right now, realized vol is up around 12%, so it's quite a bit higher. And so what's interesting is there is, even though the VIX is at say 13. The VIX isn't particularly expensive right now because the market has been moving quite a bit. And so the other factor that we have to consider here is that in markets that have relative calm, which I think if we get past the inflation print tomorrow, that calm can really take over. And there's a long way for that to sort of collapse over the next couple of months. And that can also really buoy markets and lift them up. We call this the Vanna flows, when implied vol is coming down, and that just helps to gently kind of just like raise the market up. And so there are options dynamics here that would also support, a longer term market rally. And the market was so complacent into April that I think we could just get back to that level again because I don't see anything to stop it, right? And so, you talk about not only these narratives that are possibly to start percolating again on the AI trade. Well, vols and the options dynamics that have been so supportive of markets are still set to sort of come back into the market. Another one of those I would say is these call overriding funds, systematic call overriding funds. So there are some of the biggest ETFs in the country, like JEPI, are people own baskets of stocks and they sell 1 month S&P calls, right? And those calls add what we call positive dealer gamma to the market. The reason that you should care about positive dealer gamma if you're a futures trader is because positive gamma means that dealer hedging flows should suppress market volatility. So that helps to take risk off the table. It creates smaller intraday moves, which you should be aware of if you're trading futures. But it also means that markets are generally going to drift higher, right, over time. And so those dynamics are still very much in play here. And if we get past this speed bump of CPI next tomorrow, and Powell's next few speeches and Nvidia earnings are fine to good to great, then we should really see these dynamics kick in of volatility coming down and markets just kind of like grinding higher.
Is that a new phenomenon? How as far as
that's
these
something that we've been
ETFs?
studying for a while.
Yeah.
But what is a new phenomenon is the size of these overriding funds.
Okay.
They've in the last 2 years really grown massively, and a lot of that is the dividend trade. So these funds advertise a yield of 8%, and I think that it attracts a lot of flow because of those reasons. So QILD is a massive NASDAQ product that does the same thing, and we're talking about 30-40 billion dollars of AUM in these products on just single products. So I think the overall complex is something like 200 billion if you talk about derivative overriding funds or derivative linked ETFs. And so it's a huge complex. So these are material flows that are affecting markets on a day in and day out basis. So you may be able to sort of dislodge these flows on a short term like in April, but guess what? Like the flows are still there. So like the macro flows may override the options flows on a short-term basis, but those options flows just keep coming back, right? It's like you can knock me down if you're a fighter, but I'm going to get back up and, just I'm still here. Like you just can't ever knock me out. And so, those are also dynamics that are really in play, particularly here as we're over 5,200 in the S&P. That positive gamma dynamic is just increases asymmetrically.
And just to further clarify, are they using 0DTE and trading every day, or are they?
There's a
looking
variety of those options.
Okay.
Generally,
So
what
they
they're
could be
doing
longer.
is they're either laddering out options with a target of 1 month to expiration, so they're longer dated a little bit.
Okay.
So some funds ladder them, so they'll have some weekly exposure, but they're constantly selling the 30-day and then just letting it sort of decay, and then sell some more 30-day and let it. So they have a rolling portfolio. And like QILD will always sell a 1 month option. So the bigger ones are a little bit longer dated, but there's an increase in interest in selling short dated options and 0DT flows. And by the way, our studies show that 0DT options flows suppress volatility. That's what we take away from it, meaning that the rips are sold and the dips are bought, and it leads to the market not having big directional moves. Like we don't see those kind of open at the highs, close at the lows, or vice versa moves anymore, right? They don't seem to happen with very much frequency anymore. And I believe, and our data shows, it's in large part due to 0DT options flow.
Well, Brent, a lot discussed today. I'm sure I could go on more and ask you more questions, but we've run out of time, as we always do. Where can people find you on the internet?
Thanks for that opportunity. At SpotGamma on Twitter, and you can see us at spotgamma.com, and you can get a free service of our daily notes and options analytics.
Yeah, and
Along
it sounds
with, definitely want to mention our NinjaTrader integration, so you can get all of our options levels piped directly to NinjaTrader each and every morning.
Yeah, and I was going to say your charity work, commendable. You had some great speakers there, a couple of them I know, and it's just good to see that involvement. So kudos to you.
Thanks very much.
And those at SpotGamma.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.